Hey guys, Adam Burns here. I'm with my wife Shelby, who usually has tons of questions about real estate based on the episodes that we're filming. But today, we're here to answer your viewer questions. A lot of you have written in with questions and comments on our videos, and we're going to read some of those today and answer them for you here. So, what's our first question?
Yeah, so first question, this was actually a question from a previous episode of that you mentioned screw piles. What are screw piles?
Yeah, so I talked about that in one of our construction update videos. Screw piles are essentially long metal tubes with a helical screw to them. They look like giant screws that you normally put into wood, but they drill down deep into the soil so that the building can sit on those and transfers the load from the building to that deeper soil. So they're typically used where the topsoil doesn't have the bearing capacity or enough kind of density to it to hold up the building.
Okay.
So the screw piles penetrate down deep so that the building can set on that deeper soil that has the better density or better bearing capacity to it so the building doesn't sink.
And do all of your construction properties use screw piles, or was this something new that you decided to use?
So it depends on the property. We do what's called a geotechnical report, which studies the type of soils underneath the surface to understand what the bearing capacity is and the soils as you go down.
Yeah.
We do that by drilling core samples. So we drill down in and then we take it out and analyze the soil that's there in the dirt and the clay and everything else. So our engineers will decide if the bearing capacity of the existing soil is such that a building can just sit right on it, or if we need a system like this. It's called a deep foundation.
Oh, interesting.
There's many, many different ways to skin this cat. It doesn't have to just be screw piles.
Sure.
There's a number of different piles or ways of transitioning from bearing on the surface to bearing down deep. Screw piles just being one of the most economical and effective ways of doing that.
Awesome.
Cool. So what else we got?
All right. So this question comes from Olia. I want to start looking at properties to buy for investment. Would a plot of land be a better choice to buy, hold, and then sell rather than buying a single family or duplex?
So, yeah. So my understanding of that question is, do I buy something that's cheaper, a piece of land, and just hold it for appreciation and
Yep.
then resell it?
Correct.
Or do I buy a single family or duplex, hold it, and then resell it? So from the sound of the question, it sounds like we're comparing appreciation of different assets, I would call it.
Right.
Land or single family, two family.
Yep.
If we're looking at those two, I think that if you don't know zoning and you don't know local ordinance and how that piece of land would be treated,
And
or
this
if
is maybe your first property.
absolutely. So if this is your first property, I would not steer somebody toward buying a piece of land because chances are in a denser metropolitan area, that piece of land probably isn't buildable. That's why it hasn't been built on. They're not making any more land. So, usually somebody would come in and have built a building there if it was easily possible.
Good
So buying that piece of land, you're not going to be able to do anything with it. So you're just paying taxes every single year, year over year, taxes, taxes, taxes. So there's a cost to it, but it doesn't necessarily appreciate as fast as something that has a useful life or useful value to it. Like with a single family or a two family, you can rent them out, gain some income. You could live in it yourself, so you could have that personal use of the property. You're going to get far more useful value out of the single family or the duplex.
Right.
And those are also going to appreciate much more quickly than a plot of land that may or may not be buildable.
Does your answer change if I'm a seasoned developer?
My answer could potentially change if you're a seasoned developer, if you know that the land can be improved in the future, or if you're able to purchase that piece of land subject to getting permits to build something on it. Then you're going to have a greater forced appreciation value because you're buying something that's super affordable or more affordable than buying an existing building.
Right.
But you're going to go through the process of constructing something new there, thereby creating more value than the money you're putting into it and creating further forced appreciation and further return for yourself.
Gotcha. Awesome. Well, thanks for answering that.
Yeah. Do we have any other questions?
We do. So this question comes from Yoni John, and this individual wants to know, okay, how do they get in touch with you if they are looking to work with you?
Yeah, so if you're in the Boston area and you want to collaborate or you want to, talk about real estate development or get in touch with us for any other reason, you can send us a comment or a DM on any of our social media. You can also send me a direct email, info@burnsrealtyboston.com. Best way to get in touch is email, comment, or DM. I think I remember this particular comment. He was asking about working with us and kind of learning more about development. Is that right?
Yeah, yep, that's correct.
Yeah, so we actually run an intern program every single summer. So if there's any interest in working with us as an intern in 2022, next summer, we'll start taking applications for that in the next few months. So feel free to get in touch if you have interest in learning more about development and construction and the real estate industry in general. Or if you have some other talent that you think could be useful to us, we'd love to hear from you. So we're all ears. If you want to reach out, definitely use any of the methods we just talked about and get in touch with us.
Awesome. All right, thanks for answering that.
Do we have any other questions?
We do. So this one is from an anonymous viewer wondering, what should they look for in a real estate agent? Like, what makes a great real estate agent?
That's a good question. I think it differs based on the individual and the consumer. So it's going to vary by person what they could value or what they should be valuing in an agent. But I think above all else, experience in, so if you're a buyer, experience in what you're looking to buy, or if you're a seller, experience in selling in your local market or the type of home that you're looking to sell. So what I mean by that is if you're looking for a multifamily property for investment, you should be working with a real estate agent that has some experience in investment property and can understand what those important things are. I mentioned local market. Real estate is highly localized, so working with somebody that has experience in your local market is important. Massachusetts being a small state, we kind of do real estate all over Massachusetts because it is such a small state. We have experience pretty much everywhere in the state, and different agents within our group have experience in different towns and different areas of the state, but we all work as one and we bounce ideas off each other. So finding an agent that's experienced locally in the market that you're looking in, as well as with the type of property that you're looking for, and then somebody you just get along with. You want to feel comfortable working with this person because there needs to be a sense of trust. So somebody that you trust and feel comfortable with is a paramount feature to look for regardless of who you are and what you're looking for. So I'd say interview any number of agents, anybody that you can find. Zillow is a great resource for finding agents that are active in the market. Googling local real estate agents or local real estate brokerages and looking at the About Me page, seeing whose bio kind of speaks to you at the end of the day is another good way to find potential agents to work with. And then if you do that, schedule a 10-minute phone call with each of the people that you're considering. Run through a couple of basic questions and ask them things that will help you get to the bottom of, do they really understand what you're looking for?
And work with just one. Because full disclosure, when I first moved
Yes.
to Boston, I think it's important to tell this story. I worked with at least 5 different agents all at once, thinking that they each were going to show me a different property. And they did, but I was all about who could show me the property the quickest. Little did I know that all agents have access to the same database. So that one agent could have shown me all the same properties. But I'm wondering, what is the benefit of working with just one? Why should I have to choose just one? Or should I choose just one versus working with multiple agents?
You should work with one agent and trust that they're going to do their best to show you everything that they could possibly show you. It goes back to that trust and that relationship that I was kind of touching on previously. Working with somebody that you're comfortable with, they also need to feel comfortable knowing that you're committed to working with them. Because if they don't have commitment from you, that you're only working with them, they're not going to work as hard for you knowing that they could just as easily lose the opportunity for their commission at any point because you're working with multiple people.
Sure.
So it boils down to respect and the relationship. So if you have this open, honest relationship with one person and you can tell them what you like and what you don't like, they're going to work harder for you knowing that they have your committed business, and they're going to make sure that they go above and beyond to get you into a home at the end of the day.
Gotcha. Good to know.
Yeah.
Thanks for sharing. All right.
Absolutely.
Any other questions that we have?
So I did have one other question that was posed by Bet Ann. It was a little bit longer, so I'm going to paraphrase it, but it essentially boils down to if you're going to live in a community that has an expensive HOA, like a guard service, lawn maintenance, road maintenance, maybe water features that need to be maintained, if you live in a community like that, does it make more sense to rent or buy into that sort of community? And HOA meaning homeowners association, so people that take care of all of those things that I just listed, as well as kind of manage bringing in those funds and accounting and just taking care of the community in general. So I guess I would answer that as you would have to go back to the math that we talk about in our rent versus buying episode and understand the metrics for sunk costs versus renting, sunk costs versus buying. I don't think that there's one clear choice or one clear answer for do you rent or buy in that sort of higher HOA community, because if you're renting in that community, it's likely that those HOA fees are just being built into a higher rent.
Yep.
And then if you're buying, those HOA fees are going to just be contributing to your further sunk costs of buying. So when we talked about in that episode, comparing the sunk costs of renting versus the sunk costs of buying, those HOA fees are going to make it a higher cost to buy, but they're also probably going to mean a higher sunk cost of renting. So just going through, again, go back to that episode, we really break it down on how to run the cost for sunk cost in renting, sunk cost in buying, and then just comparing the two. Is it cheaper long-term to rent a property in that community and enjoy those lovely amenities, or does it make more sense to buy? It's going to come down to the math at the end of the day.
Yeah, and it might make sense, correct me if I'm wrong, to also factor in that you are hopefully building value in your home over time. You own something, right? Whereas if you're renting, you don't actually have a ton of equity, if any, in the home. You know, you're kind of, I hate to say throwing money away, but you're not investing in something. Whereas if you own it, you're investing in that. Does that come into play here?
Absolutely. So that's an additional factor that we talked about in that episode that isn't necessarily a direct impact on the math of is it more costly to rent or to buy, but it's additional factor that you definitely have to consider. You know, homes do generally appreciate over time. Obviously, there's some short-term dips in the market, but generally speaking, over the long term, home values do trend upwards. And then in a community like this where there's higher HOA fees is probably better maintained. And if it's better maintained, it's probably going to hold its value much better and appreciate more quickly than the broader market or if you were to rent or buy in the surrounding area.
Right. And I think it's important to also take into consideration, like, how often do you want to be moving, right? Like if you're renting, you're at your landlord's discretion at the end of the day of how long they want to keep you in there as a tenant, versus if you buy, you kind of get to decide how long you want to live there for.
Absolutely. Yeah. So there's a lot of different life decisions that play into that overall rent versus buy decision.
Yep.
But yeah, we boiled it down simply in that episode to just a math equation, but you're very right that there are a whole litany of other things to think about when you make that decision.
Now, thinking about renting from a different perspective, like say that I'm thinking of it from like, okay, maybe I decided to buy regardless, but rent it out to somebody else, right? Do you find, and you might not have the answer to this and that's okay, do you find that these communities allow folks to do that, to buy into this community with a homeowners association and then rent it out to somebody else?
Yeah, it's not something that I can answer for you.
That's okay.
So if you are buying into a community with a homeowners association, it's going to be...
Usually they're pretty private.
Yeah, but it's going to be laid out in their documentation. So
If they allow
every homeowners association is going to have different rules and regulations.
Sure.
So I can't give you a blanket answer to would that be allowed.
Yeah.
It's going to depend on the rules and regulations for that homeowners association.
Yeah, but something to look into. Awesome.
Yeah.
Well, thank you for answering that.
Yeah, so that's all the viewer questions we had today. Thanks so much, guys. Hey guys, Adam Burns here. Let's bring it today on financing options. Now, some of you might already know, but there's various options available from lender to lender, and every one of those lenders is going to offer you something a little bit different. So it's vitally important when you're going through the loan process to go out there and shop your rates and shop your terms. Talk to as many lenders as you can and find out what's going to be best for you. Today, for the sake of this episode, I'm going to break things down into 3 different categories of loans for discussion purposes. So the 3 that we'll talk about today will be conventional, government insured, and commercial financing. Let's talk about conventional financing first. Conventional loans come in 2 different types, either conforming or non-conforming. Conforming loans fall within a certain set of guidelines, and non-conforming fall outside of those guidelines. The guidelines are typically related to loan balance or loan size and other terms such as the amount of commercial space in the building or the amount of owner occupancy. Either way, conventional financing can be used for the purchase of either a primary residence or a vacation home. So as I mentioned, one of the reasons why a loan might be non-conforming is because it's just too large. These are referred to as jumbo loans anytime you fall outside of the guidelines of the loan maximums. Now, if you were to buy a house in most of the United States, the maximum amount of loan that you could take to still be conforming would be $548,250. In certain high-cost areas, that loan maximum actually goes up to $822,375. So, if your loan amount is below these, well, now you're conventional and conforming. If you purchase a house that's more expensive and your loan falls outside of these guidelines, well, you're non-conforming at that point. Much like other types of investment vehicles, mortgage loans can actually be bought and sold in what's referred to as the secondary mortgage market. In this market, typically what's bought and sold is conventional conforming loans like we just talked about. Non-conforming can also be bought and sold, but it just doesn't happen quite as often. Now, the greatest consumer of mortgage loans from the secondary market, you might have actually heard of, Fannie Mae and Freddie Mac. These 2 agencies purchase most of the loans that show up in the secondary mortgage market. Now, there's a whole complex system going on behind the scenes here, and we'd love to cover it in a future episode. So if you have interest, drop us a comment below and let us know. As I mentioned, non-conforming loans don't typically get sold on the secondary mortgage market. So what happens with these loans? Well, lenders that issue non-conforming loans typically keep them on their books and benefit from the interest payments that you're making. Lenders that do this are said to have what's called a portfolio loan program and keep the loans so that they can benefit from the future cash flows. We touched on this in another episode, but just a friendly reminder and a side note that if you put down less than 20% on a conventional loan, then you're going to be paying PMI or primary mortgage insurance. So keep that in mind when you're shopping for your loans, that there will be this additional cost when you go conventional and you put down less than 20%. The second type of loan that we're going to touch on today is government insured loans. These loans are only for your primary residence. They typically carry a low down payment, which is really beneficial for you as the consumer, but it is riskier for the lender, hence the government guarantee. 3 different government agencies actually back these loans. They are FHA, USDA, and VA. FHA loans allow borrowers to put down as little as 3.5%. These loans can also allow you to roll in some construction proceeds so you can renovate the property that you're buying. These are also allowed to be used on multifamily properties. So if you're trying to get your start in real estate, this is a great option. If you want to hear more about this, go back to the previous episode we did on getting your start in real estate and buying your first investment property. As another side note about mortgage insurance, keep in mind that if you're putting down less than 10% on an FHA loan, you're going to pay PMI. This adds to the cost of the loan, so make sure you're keeping it in mind as you're searching. USDA loans allow borrowers with low income to purchase in rural areas specified as USDA eligible with as little as 0% down. VA loans allow members of the military and veterans alike to purchase a home also with as little as 0% down, but don't require any mortgage insurance whatsoever. The third type of financing we're going to cover today is commercial financing. These loans come from lending institutions as well as some private investors or individuals. Loans like this can be used for the purchase of a non-residential property or maybe a multifamily property that the owner is not going to live in and is only purchasing for the cash flows. These type of loans carry higher interest amounts and also require at least 25% down because the lender making the loan is taking on greater risk by doing so, and they're going to keep it on their books for the cash flow. Under the umbrella of commercial financing, there's three different types that we'll touch on briefly. The first is long-term financing, second is hard money, and third is construction financing. Long-term commercial financing is much like the other mortgage loans that we've talked about in this episode, only difference being they mature much sooner. An FHA or a conventional loan might mature in 30 years, but if we talk about commercial financing in long-term loans, those loans typically mature in only 5 to 10 years. Hard money loans typically come from private lenders or individuals lending out their money. Now these type of loans usually carry a very high interest rate, sometimes as high as 18 or 20%, and have very short windows of repayment, maybe 6 or 12 months at the most. These really harsh terms are what give the loans their name, hard money. These loan types are very popular with fix and flip investors who know that they're going to be in a deal for a very short period of time, or those that are just starting out in the real estate development industry and don't have the track record needed to go to a bank or a traditional lender. The third and final type of commercial financing is the construction loan. Construction loans allow you to roll in the cost of building a new building or renovating an existing building into the overall loan, so you only have one single payment to make every month. These loans are of slightly higher risk to the lender, so they do carry a little bit higher interest rate, not quite as high as the hard money, but they're at greater risk because you repaying that loan is so heavily dependent on being able to lease or sell the property as you intended. We've only just scratched the surface of financing in general, but unfortunately that's all we have time for today. If you have any questions on anything we covered in today's episode, or questions about financing in general, drop me a comment below and we'll definitely cover it in a future episode. Thanks so much for watching. Hope you enjoy the rest of your day. Hey guys, Adam Burns here. I'm with my wife Shelby. Like all of you, she has lots of questions about real estate, and we just got done watching the rough edit of our finance options episode, and I think you have some questions for me.
Of course.
Of course.
Always have questions.
What do you got?
So first question is, you talk about different financing, loan options. One of the ones you mentioned is conventional. What are the downsides of having a loan or financing option not backed by the government?
Yeah, so conventional financing is not backed by the government. If you have and take conventional financing, the benefit of government backing is really there for the lender. It's not for you as the consumer.
Okay.
So the government backing is there in case you were to default on the loan. They're to step in and basically make it right with the lender. So there's really no downside for you as a consumer to not have a government-backed loan. I think it's actually better because you're able to put down enough to qualify for conventional financing. You don't have to worry about some of the other nuance that goes along with it.
So is it harder to get because lenders might be more enticed to have a government-backed option? Do you have to have certain credit? Are there certain standards in place to be able to get such an option?
There's actually more hoops to jump through when it comes to government-backed loans.
Really?
More check boxes to check and more things that they look into.
Gotcha. So it's not necessarily harder, and will a lot of lenders provide that option to you, or?
Conventional financing?
Yep.
Yeah, most lenders, that's all they provide is conventional financing. It's more niche to actually go out and get an FHA loan or a VA loan or a USDA loan.
Even though it's potentially riskier for them, the lender?
It's not. So the government backing is there to make it less risky, but not all lenders lend in those avenues.
Gotcha. But you're taking away that government backing. So it would be more risky, right?
No, because you're putting down more money. So
I
by
see.
putting down more money, the lender is at less risk because you're putting down or taking away their risk of default. So because you have a higher percentage of your equity in the property, it's less likely that you're not going to be able to pay back that loan if the property ever had to be sold in foreclosure.
Gotcha. So that's the biggest difference. You need more down with the conventional.
Correct.
Okay. Awesome. Thank you.
Yeah, no problem. What else do you want to ask?
All right. So you mentioned loans can be sold on the secondary market. What happens to my loan if it's sold on the secondary market? Is it no longer my loan? Do my rates change? Does somebody else take over my loan?
Yeah, so nothing changes if your loan gets sold. It's just who is the beneficiary of the interest and the principal payments that you're making. So where your money goes changes, but from the face of it, nothing changes for you. The interest rate doesn't change, the terms of the loan don't change. You might even have the same servicer or the same person that's collecting your monthly payment. That might even stay the same. So there's really no difference to you as the consumer. The thing that changes is the person who is the beneficiary.
Is it a person or is it a bank?
I'm saying person, but it's usually an institution. Like I mentioned in the episode, it's Fannie and Freddie are the two largest consumers of purchased secondary mortgage market loans.
Okay.
But yeah, other institutions do purchase these loans usually in bulk.
Okay, so it just changes hands. So it might go from Fannie to Freddie?
Sure, or something along those lines.
Okay, and there's no additional risk with that happening, or should I be worried because it's changing hands?
It changes nothing for you.
Okay, and can you explain who Fannie and Freddie are so that people don't think that they're our cousins? For those of us that don't know who they are or what they do, give me some context to who Fannie and Freddie are.
I should have had
Or
you
what
ask me
they
these
are.
questions before because I actually don't know. I mean, they're just government.
That's why I was like, do you want to
agencies.
look at them? Yeah.
Good question.
So
So not our
we
aunts
might
and
have to do
uncles.
that all over again. So, guys, I guess we actually don't know here exactly who Fannie Mae and Freddie Mac are. So this is a question for you, the viewer. If you can drop me a comment on this video and be the first to tell me exactly who Fannie Mae and Freddie Mac are and their function, I'll give you a $100 Amazon gift card for that accurate answer. But you got to be the first. What else?
All right. Out of the different loan options you mentioned, which one offers the best interest rate?
Best interest rate, meaning the lowest interest rate?
Yeah, or however you would interpret it.
So interest rates are tied a lot to how risky the loan is or how much perceived risk there is in the loan.
Sure.
So the less risky the loan, the lower the interest rate. So if you have a conventional conforming loan, that's pretty non-risky. So that's going to be kind of the lowest risk out of everything listed.
Okay.
And then the risk continues to go down as you put more money down. So as the bank has less of a position in the deal, the amount of interest actually drops as well. So we talked about putting down at least 20% to get rid of PMI. But if you put down more than 20%, if you put down 30, 40, 50, 60%, you're going to get a much lower interest rate the more money you put down.
Gotcha. Is there one that you tend to choose more than the others?
So I didn't mention in the episode, but we do a lot of construction financing, which is commercial lending.
Okay.
Our rates, as I mentioned in the episode, also are a little bit higher than a traditional conforming loan.
Right.
Usually a point or 1% to 0.5% higher.
Okay.
But yeah, it all depends on the lender and the perceived risk.
Okay. So speaking of risk, have you ever done a hard money loan?
I've not. So I got my start a couple of the other different ways that we talked about in buying our first income property and in that episode, but I thankfully never had to take on hard money.
When would that be a good option for somebody? Like when would somebody choose that?
Yeah,
Because
so
interest rates are typically higher, right?
I mentioned it in the episode, but that's usually like a fix or flip investor, somebody that knows that, all right, I'm going to buy this single family. I have to do the kitchens and the baths. I'm going to be in and out in 3 months. I'll be able to sell it fairly quickly. You know, that might be an opportunity where they're going to pay 18%. But,
Shorter. So shorter term is what I'm hearing.
yeah, so something that's quicker and you have a confidence that you're going to be in and out of the deal in a shorter period of time.
Gotcha. Okay.
The other option is somebody that might be new to the industry and doesn't take our advice on one of the other ways to get into the industry and take the time to build that.
Okay.
People that don't have a track record will typically take hard money for their first few deals to build up that track record.
And who typically lends? Is it an individual, a corporation, a bank? Where can folks find these hard money lenders?
Yeah, there's various ways. A lot of them are individual investors, somebody that lends from their own portfolio because they like the interest rate that they can charge, but there's also corporations and companies that do hard money lending.
Gotcha. Awesome. Thanks for answering that.
Yeah, no problem. Do you have any more questions for me?
I don't. I think you answered them all. Thank you.
All right. Thanks so much. Appreciate you watching, guys. See you next time. Hey guys, Adam Burns here, bringing it to you on the COVID impact. We're not touching on it too much in today's episode, but we have noticed a lot of impacts on the construction trades throughout COVID. And today's episode is actually sponsored by one of our favorites, John McHugh of McHugh Electric. All of you have been asking who we use for these various trades and who we like in the industry. He is one of the best. So if you're in the Boston market for an electrician, reach out to John McHugh of McHugh Electric and he'll take care of you. Now back to the COVID impact on the real estate market. So my team and I have a ton of experience in various ups and downs in the real estate market over the years. We've taken that, coupled with our experiences during COVID, and we're helping put together some predictions for the future here in this episode. Unfortunately, I don't have a crystal ball, so we can't guarantee that some of these or all of these predictions are even going to come true, but these are what we're basing our future decision making on and what we hope will actually help you make some decisions as well. So we're going to break this down into a couple of different phases. First thing we're going to talk about is when COVID first struck. During COVID, when things first were getting started, there's a lot of worry and angst in the market, and sellers weren't understanding where the market was going to go, and there was a lot of panic selling, driving prices lower across the board. Now, this didn't happen a ton in Boston or some more stable markets like Boston, but we did see some of that happening here as well. For example, we were able to actually buy a beautiful brick building in South Boston for $1.5 million that ended up appraising for $2 million without any work being done to it. That's $500,000 in equity just for knowing the right time to buy. The work from home lifestyle contributed to an uptick in suburban buying and vacation rental markets across the United States, with cities such as Boston feeling most of the strain in their sales and rental market, where areas are more constrained and people didn't have the space to spread out and work from home. During the COVID-19 pandemic, we were in a worldwide recession. People were losing their jobs on a daily basis, trade was disrupted, materials were not being produced, and all of this led to uncertainty for the future. People didn't know where things were going to go, but now, fortunately, after all of that, we're on the upswing, which leads me to my next point. Post-mask mandate, when things started to get back to normal and we started coming out of that recession, we noticed that there was a huge buying boom as buyers who had sat on the sidelines afraid to get into the market returned to the market. As time went on, sellers who had also been sitting on the sidelines or holding onto their property also started joining the market in force. Since then, we've seen more of an equilibrium between buyers and sellers as more inventory has entered the market to meet the demand of those buyers. So in simple economic terms, when the supply in the market exceeds the demand, or we have more sellers than buyers, there's going to be further downward pressure on pricing because there's more inventory than people to buy it. Right now, although there is a lot of supply in the market, that downward pricing pressure is being counteracted by the inflation and also the high cost of building materials for new construction. Maybe you've heard about the crazy high lumber prices earlier this year. This is caused by lumber mills and factories pulling back production in anticipation of a lull in building during COVID. Unfortunately, the opposite happened as homeowners built decks and additions, and suburban markets added additional housing units to meet the demand. This additional demand, coupled with the low supply, caused lumber and other building materials to spike astronomically. This same trend has played out for most other building materials, not just lumber. Factories who laid off workers in anticipation of the lull in building and a decreased demand have had a hard time rehiring workforce in order to catch back up with the demand in the current market. Inflation and the additional cost to build new all contributes to upward pressure on the price of existing properties. The Delta variant, which is spreading like wildfire right now across the country, has the ability to potentially knock us out of this equilibrium that we're seeing and drive prices lower again, but the true impacts have yet to be seen. The rental market has been hot for young professionals rushing back to cities where employers are telling them that offices are going to reopen and they have to be back to work in those offices come September. Investors who did well in the stock market, from the deep trough of early COVID to the highs that we're seeing today, are dumping that money into investment real estate, such as rental property and commercial assets, driving up the prices of these properties and causing an increase across the board. Now, looking forward to the future, interest rates are expected to rise in the next couple of years from the lows that we're seeing right now, which is going to reduce the buying power for millions of consumers, thus putting further downward pressure on the market. Depending on how work from home policies shift from major employers in the United States, this will have a heavy impact on where housing demand actually settles, suburbs versus city. Traffic is expected to be worse than ever, as historically low numbers of people are using public transit and are choosing to drive instead. If jobs do settle in cities, this could make commute times even worse for people and shift housing demand back to city centers where people can be close to their jobs. We believe that actually what people value in their homes has also shifted. People are now putting further emphasis on having outdoor space, having separation of spaces, and having more space in general. So we're actually seeing a shift away from open concept to more segmented floor plans where multiple occupants can have separation from one another. So in summary, initially during COVID, we saw a decrease in buyer activity in the cities and an increase in the suburbs as people's lifestyles shifted to work from home. And then this past spring and summer, we saw a buying boom as people that sat on the sidelines previously, worried about the recession, worried about COVID, returned to the market as mask mandates were lifted. Supply has since caught up with that buying boom, which we would expect to have downward pressure on the pricing in the market. But inflation and the additional cost of building materials to build new are keeping pricing stable. Looking to the future, we expect demand for city centers to increase once again as jobs shift back to in-office work and traffic becomes more unbearable as people try to commute from their suburban purchases to their jobs in the city. So we're still bullish on buying in the city as long as those properties that we're building or renovating meet those values that we talked about previously: separation of space, more space, and outdoor space. We expect pricing largely to remain stable across the market and increase slightly as interest rates rise slowly and the cost of building materials starts to normalize. The two wildcards that could throw all of this out of whack are the Delta variant, which we're watching very closely, and the severity of inflation. So we're going to be monitoring the market as things progress and keeping an eye on these wildcards. If there's interest in this episode, we'll do a future episode on another market update for you. Thanks so much for joining us and McHugh Electric for another episode of Bring It On Real Estate. Don't forget to like, comment, and subscribe for more custom content like this, and we'll see you again real soon. Hey guys, Adam Burns here, and I'm with my lovely wife Shelby. Like all of you, she has lots of questions about real estate.
Yep.
We just got done watching the rough edit of our COVID episode, and I think that she has some questions for us.
I do, of course. So, two-part question.
Oh, two-parter.
Two-parter. First, we'll take it from an investment standpoint. So, given where things are right now and with this Delta variant, and knowing, of course, where prices are, and we've kind of got I feel like, building pricing structure figured out for buying, building, etc. As an investor, what should I be doing right now, given where things are at, with the possibility of these variants leading us into what we went through last year? Basically, should I be buying something right now? Should I have something in the works and just continue to build? So do I buy and build, or do I hold off?
I feel like that was more than two parts.
Sorry. Yeah. Oh, we haven't even gotten to the second part yet.
Oh, man. So I think what I'm hearing is, what do I do now as an investor in the current market?
Yeah.
That was essentially it, right?
Yep. What should I be doing?
I mentioned in the episode that we're bullish on still buying in the city.
Okay.
I would say that I would recommend the same to anybody else that's watching this, that buying in city centers is still a sound investment. We would advise that people still continue to buy because real estate is one of those things that it's always going to continue to trend upwards.
Yep.
It might be a little bit more slowly, and there might be some, up and down fluctuation over time, but over the long term, real estate is still going to trend upwards. And we are still anticipating, even with the Delta variant, we're still looking in the direction that offices are opening this fall. People are going to be coming back to the city more and more, and traffic increasing is going to drive people back to city centers anyways.
Okay.
Building costs are another one of those factors that we're